biggest problem to solve here is actually the third-party management, because there are no third-party management companies for express car washes.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Whitney Elkins-Hutten. Whitney, how are you doing today?
I'm doing great. Thanks for having me.
Absolutely. Appreciate you being on the show. And Whitney is the director of investor education at PassiveInvesting.com, co-author of the international #1 bestseller, Resilient Women in Life and Business, host of the Passive Investing Made Simple and Multifamily Investor Nation YouTube shows and podcasts, and a partner in 800 million in real estate, all kinds of stuff, residential units, mobile home parks, single family rental, assisted living, car washes, you name it. You guys have done a lot in 11 states, and you've also flipped a bunch of stuff too. So you do it all. You kind of do it all.
Well, it was an evolution and process.
Yeah, so, right. It didn't happen overnight.
Didn't happen overnight, and some of those stages in our portfolio I've since grown out of.
Yeah,
moved on to the next thing. So,
well, that's good. It's always. I want to talk a little bit about that to start us off, because there's this hey, you got to really hyper focus on what you're good at, and you guys at the company don't just hyper focus on one thing. It's not you're doing 200 unit multifamily built in 1980. That's what you hear people say. And I'm kind of I don't have the breadth of passive investing and what they do, but we're the same. We own some retail, we own some industrial, we own mostly multifamily, but we own assisted living. So we have a variety too. I want to talk about that, the focus on one thing versus what passive investing has done, and kind of your thoughts.
Yeah. So there's what you read off, which is my personal portfolio. It's what my husband and I have built. And, we've gone through that same journey of evolution and what we want to have in our portfolio. But what we do at PassiveInvesting.com, we're actually pretty hyper-focused. And, unlike what you see in a lot of private equity firms where you have like 2 or 3 managing partners and they're all 3 trying to hold down the business, multiple pillars of the business, we actually have our different verticals managed by a managing partner. And then we have our 2 founding partners that sit over the entire strategy of the business. So our managing partners in our self-storage space are able to focus on self-storage. Our managing partner in real estate debt, she only focuses on the real estate debt portion of the business. Car washes Cameron only focuses on the car wash part of the business. And so we do have the best of both worlds, where people are able to be hyper-focused in their particular niche. And then, the 2 founding partners are able to coordinate the overall strategy of the company above that.
Yep. So it's a company that is, would you say the company is focused on it's on value add real estate, right? You guys are focused on real estate. But each niche, I just want to recap, each niche that you have has a partner involved in it that is focused on that niche specifically.
Correct. Yeah. In our, we do look for value add strategies, but we've moved away from the true, the traditional value add approach. And I think a lot of groups have done something similar, especially in the multifamily space. We're not looking for, a big CapEx or deferred maintenance project. We're probably looking to add, look for that stabilized Class A asset in a Class A area, or an up and coming Class A area that has some other types of value add. Maybe there's a lease up component to it or an expansion component. But, getting away from, a lot of that deferred maintenance, CapEx, that obsolescence, that a lot of that, honestly, for, 5, 6, 7 years ran really well in the market. But now, the cost of goods, the compression of cash flow, really, you're taking on a lot of risk with that type of development type strategy.
Yeah, I agree. When you're coming into an asset and you're having to put all that money into it right now in this type of the market cycle, like you said, a lot of expenses are way up. Labor's a lot more difficult to find. So that's just adding a bigger risk element than maybe it was 5, 6 years ago, where labor was plentiful and materials weren't as in flux as they are right now. So let's talk about kind of what you specifically are doing. Why don't you give our listeners a little bit more kind of about your background first, and then we can dive into what you're doing right now.
Absolutely. Yeah. I started off in 2002. I bought a house with a significant other, and we were gonna, rehab the property and, live together, right? Like that was our, start our lives together. But about a month after buying the property, the relationship fell apart. Everything was under my name, like everything, the mortgage, the utilities, everything. And then I panicked a little bit. I stuffed that house full of roommates. And I had no idea how to rehab a property, and YouTube did not exist back then. So I had to learn things from a book, go to classes at Home Depot, but, completed the rehab on that property. And 11 years later, turned a profit. And it was actually after I sold the property that I realized that I actually hadn't been paying for any of my housing expenses as well. Mm-hmm. And that was kind of when the light bulb came on. I'm like, whoa, how many more times can I do this? I mean, I'm young, I'm single, I had to move for a job. So it even came to me tax-free. I was like, okay, let's keep rolling with this strategy. So did several more flips on my own. And then eventually my husband, my now husband, I've only had one husband. He's going to kill me if I said now husband. Anyways, have to clarify that, right? He joined me in my antics, and we did several more projects together. But what we realized is that we were really good at creating equity, and that was fine. But we didn't have the cash flow. Like we had this dream of, having checks coming in on a, monthly or quarterly basis. We could step away from our jobs and play in the mountains all day long. And that just wasn't happening. If anything, we had another job flipping these homes. Yep. So we had to figure out how to hold on to these properties. And eventually a friend of ours pointed out, was like, why don't you put a renter in one of those properties? We were like, oh, that's genius. Why don't we do that? Did that. Long story short, you can't always take your houses you flip and make them good buy and hold properties. So we had to go back to the drawing board and learn how to do the math behind buy and hold rental real estate. And it's kind of funny because I have a master's in epidemiology, which is very heavy in statistics and math. So everybody kind of razzes me. And I'm like, hey, guys, how you monitor a disease movement is not the same as how you it's single family or multifamily property. Two different, all different sets of terminology here. But if anybody knows me, I'm a ready, fire, aim type person. So, somebody says, hold on to the properties. I'm down that rabbit hole. Find as many single family properties as I can once I figured out how to get them to cash flow. Yep. And, we continued, utilizing what's now known as the BRRRR strategy. So flipping these skills that we had acquired and building up buckets of equity, tagging in some cash flow.
Yep.
But then we had hit our next ceiling of achievement. We had our baby girl, and I was taking care of some family members, and I just needed my time back, like truly needed my time back. But what I had created for myself was another job. Real estate, buy and hold real estate, if you are operating it is time leveraged.
Yes.
It's passive income and not passive with your time. So that's when we decided we were going to scale up through multifamily real estate. But we couldn't decide if we want to do it actively or passively. So if you can't decide, do both. Don't recommend that necessarily, but I did. I launched down both pathways and really appreciated my journey through, working in private equity. But at the same time, what's really helped me unlock true financial freedom, true location independence, freedom of choice, of how I spend my time has been taking all of my active income, which is one of those pillars of wealth creation that so many people talk about, and moving it into taking those chips off the table and putting it into a passive investment.
Love it. It's this single family, like you guys are doing the Burr method, the single family. I did the same thing. And I hear so many people that there's so many people that have, and a lot of them like their jobs. They like their jobs. They got these, they got a family, all this, and then they do exactly what you and I both did is they buy all these single family homes. They think it's passive income. It's going to be passive income. It's going to be great. And all of a sudden they realize they got this second job. And they're going, this isn't what I wanted to create. And then that's that like uncle at the, family reunion you talk to, and they're like, real estate's the worst ever. Tenants, the toilets, the trash. And you like hear that. You're like, oh, okay, well, I'm going to ignore that guy and start buying my own single family houses. And then you realize, no, tenants, toilets, trash do exist.
They do. But I mean, even, we had 30.
Yeah.
Well, we got up to like 35 at one point in time, but we pretty consistently kept 30. Some of them we would hold on to almost like turnkey style with the intention of flipping them out in a year. But we were still doing about 10 flips, in a year too. But then my husband was like, I want to step away from my job too. And I'm like, wait, we didn't do the math for that. That means 80 single family homes. Stick a fork to me. No way.
Think of how many. Yeah, exactly. Think of how many tenants, toilets, and trashes now we got. That's a lot more work. And as you scale, I had about 100 of them. And as you scale, then get bigger, you think, oh, it's going to be so much easier. Some parts do, some parts get harder. But what happens too is the profitability per building actually goes down because now you've just got more expenses and more overhead and things like that. People don't understand that. So now when you're like making X amount per building at 35, you go up to 80 and you're like, well, I'm not making as much per building. Now I got to get to 100. And so it's a little different.
It keeps on going.
Yeah, it keeps on going. Right. So with the change, you switched over from single family did you sell all those single families?
The original 30, they're all gone. We still have 6 single family units, but they're more midterm rentals now. So not your B class rentals. These are A class rentals.
What would you define? What's a midterm rental? So people know.
We actually, we write the contracts on a 30-day monthly basis. So either 30 days, maybe 6 months.
And who are these people that would be renting these houses?
So it could be somebody like corporate that's coming in, that just needs to be in town for their job, move their family while they're going to training or something like that for like a month or 2 months, maybe 3. It could be somebody who's, maybe they had their house burned down and they need they're rebuilding, or maybe they're building a home. Maybe it's not, something totally positive and not even a disaster, but somebody who just needs a housing solution for a very short term. But those are typically our tenants in these few properties. And we have one short-term rental too.
So now you're into a lot of different asset classes. Do you have like a favorite, which one, or one you're most excited about today? Maybe let's do this. One you're most excited about today and one you're kind of maybe the least excited about today.
That's interesting. I'd have to think on that. And I think for me that I've recentered on how I want to build my portfolio or continue to scale my portfolio. And, I don't click on the headlines. I'm ignoring a lot of the headlines out there in today's market, but really I believe, and I guess this is what I'm excited about. I still believe residential real estate, for a variety of reasons, should be the core part of, well, at least my portfolio. And I encourage a lot of people to look at this lens because everybody needs a roof over their head. Yeah. They need a place to rest at the end of the day. We're underbuilt by 4.3 million homes. Now that's just not broadly across the United States. These, are pocketed in certain areas. Yeah.
Some are overbuilt, some are underbuilt.
Exactly. Yeah. So we're seeing a lot of those dynamics shift, in the last, 6 to 9 months, I think, which has been a little jarring for some people. But largely, I still really believe in the core multifamily, single family. I like now scale, so I'm not doing so many single family properties anymore. But then I have to look outside, like once you have that core portfolio set, now what are people going to be looking for? What is your customer? How can we sell a different thing to the same customer? Essentially, self-storage. People love their things. Self-storage is the next kind of common sense strategy. And then also people love their cars. And oftentimes take better care of their cars than they do their homes. And so, we're really excited, at passiveinvesting.com for our express car washes.
Yeah, it's an interesting, the car wash thing is really interesting to me. We don't have car washes like you guys are building in Minnesota until
I live in
very
Colorado.
recently.
We don't have them here, very many of them here either. So
Yeah. So it's a little different model. I'm not sure. I see a couple now going in our area, and it'll be interesting to see how well they work in Minnesota. You don't wash your car very often in the winter because it's freaking cold and it freezes. And so you can't really wash it when it's, -20 below. So it'll be interesting to see how that model works. Obviously, where you guys are doing them, I feel like they have been just been around longer, I guess, and maybe more profitable. But what do you like about car washes, and maybe what are some negatives? So let's talk about some of the positives that you really like about the car washes and providing investors good returns.
Yeah. Well, and so I'll answer it two different directions. One is a limited partner. Like as me, like if I were an investor looking at investors today, limited partner investors are still looking for yield, even in compressed cap rates. I think you and I are both part of the same group. We see a lot of deals float through that group, and people are like, it doesn't have enough cash flow. And I'm like, well, because that's not the part of the market cycle that we're in, like for multifamily, right. and oftentimes even self-storage. So this is a unique strategy to still kind of chase some of that yield. It is not a real estate deal. I think that's where a lot of people, have to understand what place does this asset have in their portfolio. It's a cash flowing business that owns, in the way we own it at passiveinvesting.com is we actually own the land, we own the brand, we own the third party management company, we own everything about that. And so to me, that's the safest way to invest in this type of asset. But it really truly is a cash flowing business where we own the underlying real estate and the underlying brand on all of the assets.
What type of cash flow can investors potentially see?
Yeah, the way we're structuring our deals is we're doing, depending on when somebody's listening to this, a 10% preferred return. But, cash flow year one during a stabilization year when we're picking up the properties is probably going to be about 7%, on average.
Still really good.
Still really good. And then we're probably floating up over that 10% prof, in year two, maybe 3, depending, are we acquiring it in the rush of summer or, in, more kind of a down season?
Are you acquiring or are you building, or both?
We're doing actually both. And but our investors actually get to choose which side of the portfolio they want to engage in.
Oh,
do they want to, and they can do both. And like I said, we're not doing any franchise strategies. We're not doing any rent backs on the land. So we truly own the land, own the brand. And that's the reason why is we're scaling 250 to 300 locations in order to IPO that. Our backup exit strategy would be to roll up and sell to REIT or another private equity group, which we're already in conversations with to understand what kind of product they're looking for. And one of the biggest things we can solve here, beyond good branding, amazing customer service, overlying technology, updating equipment for better operational efficiencies. But the biggest problem to solve here is actually the third-party management, because there are no third-party management companies for express car washes. And we've actually built the first third-party management company we're focused on managing our own car washes to date. But that is something that, gives us immense, just huge power as we, one, continue to scale, but two, like upon exit.
Yep. A good competitive advantage over everybody else, obviously, if you guys are building that kind of that first one. Yeah, an interesting business. I think obviously it's like you said, I mean, it has the real estate component, right? But it relies on the business operations. It's more of a business side of it than it is that real estate. The real estate is still worth money. It can sell in the end, but it relies on operations.
Absolutely. Well, and that's where we're taking a lot of our technology that we've developed with our self-storage side of the business and layering it onto the car wash side of the business. And so essentially, instead of somebody renting like a garage, and being able to, work with our call center in order to get access, to the rental and, manipulate their contract throughout the term of the rental, we're taking that technology and essentially we're putting the barcode on the car, and now the car wash knows, okay, what are they on? One, they're on a monthly recurring revenue model, so no single pay. They're on a monthly recurring revenue model. But are they on a $25 tier or $45 tier? Do they get a wax and a tire shine like every time they come through, or just on every 4 times they come through, or every 2 months? Like, so we can actually program that in to the tunnel. And one, deliver just amazing customer service, but two, that actually helps modulate our expenditures on the back end.
Yeah.
So there's just a lot of things that we can, it's where convenience of the automatic car washes, the ones attached to the gas stations, collide with the customer service model that a lot of people experience in a full service model. But now you get both of those worlds in under 5 minutes.
Yeah, I'm so used to the gas station model. I mean, I feel like that's only mainly the thing around here in Minnesota. It's like it's the gas station model. You go through and it just does. But we were actually in Montana and at one of those car washes that kind of the style that you guys are talking about. I was like, this is amazing, and I can see how this business is profitable. It really serves everybody, and they had the free vacuums and the whole works on this. And I'm just like, man, I got to dig in a little bit more to this model and to see what it looks like, because it's very interesting. What's a con or two? I'm sure there's a few things that maybe are difficult with these. What are some cons?
Well, I mean, I wouldn't call it a con. I think it's just, people need to understand that 2 things. One, with the cash flow, it's seasonal, right?
Mm-hmm.
So, even in the Southeast and the East, with people on monthly recurring revenue models, you still are going to probably see a little bit of dip in cash flow, into the winter months. And so there's just that. It doesn't necessarily means it impacts distributions. It really depends on how somebody is managing the cash flow of the asset.
Yeah.
But especially in the first year, it could mean if you're closing on an express car wash in November, the cash flow, it's going to look like really low cash flow when you're closing. Whereas if you closed on the same car wash in April or May, cash flows will look entirely different. Also, because the exit strategy is different, and again, it's not a con. I think just somebody, a limited partner needs to understand how this fits in their portfolio. The exit, for us, what we're trying to do is we're trying to build a large portfolio to do the IPO or a large roll-up REIT. We're still targeting that 5-year mark. However, maybe we get it done at 4, maybe we get it done in 6, right? It's the same thing, as buying, investing in a multifamily building or self-storage deal. But I think people, have clearly seen that there's an ability to exit out of a multifamily building in 3 years or less. And that's because of the recent market that we've just been through. So I think it's easier for people to wrap their heads around. And it doesn't necessarily mean that going forward, that operators will be able to exit out in 3 years or less.
Yeah.
I actually challenge that. I don't think that's going to happen for a while.
Do you think that matters, though? Do you think investors have an appetite for holding properties for 7, 10, years or more? Do you think there's an investor appetite for that? Do you guys offer anything like that?
Well, so we currently don't, and I'll tell you why, because we're performing cost segregation analyses on all of our properties and accelerating as many losses as we can to the first few years of the project.
Yep.
And when you perform that cost seg, you're essentially gathering up generally anything in 20 years or less that could depreciate. You're taking it over 5 years, right? And then we have the bonus depreciation rules where, this year, in 2023, we can take 80% of that accelerated loss in year one.
Forward it.
So,
Yep.
right. And okay. And next year it's going to tick down to 60 and then 40 and so on. Okay. But, we still have the accelerated depreciation, which is still very powerful. What happens after 5 years? Those losses, now you just have the little bit that was, that's being strung out to 27 and a half years or 39 years. So there is a real, I think, and this is something I help our investors really understand, is you need to understand, where does this tax strategy, the depreciation, play into your portfolio? You may want to have that clock reset every 5 years, kick that can down the road every 5 years, to continue accruing depreciative losses. But somebody who's like, I'm good, I don't need any more losses, or I don't want to go look for another asset in 5 years or 7 or 10, they may be more on looking for, an asset that's going to be held longer. I typically see that in mobile home parks than anything else.
Gotcha. Yeah, we a decent amount of investors that would like to find assets that they can just put their money into and not think about it for 10 plus years. But we also get plenty of them that are like, wait a second, I want my money back in 3 to 5 years. So there's a mix. It's a mix, and it's always difficult to, really understand what's maybe best for the investors. But I do like how you pointed out that there's definitely big tax savings that can happen those first year specifically, but even the first 5 years, that's where all the tax savings are. And then they kind of just go away. I suppose you wouldn't have to do the cost seg or bonus depreciation. You could just have it even keel, but that's no fun. Who wants to do that?
Well, and I think it maybe gives a little bit of insight. If somebody truly understands all the different levers they can pull in real estate, and they go in eyes wide open and say, yes, I need the losses. No, I don't need the losses. They fall in one of those two camps. I would imagine it gives a good insight of where they're at in their wealth building journey.
Yeah.
If somebody's still in the accumulation phase, I would have a question for them, like, why pigeonhole yourself in an asset for 7 to 10 years and not be using the accelerated depreciative loss rules? Whereas I can see somebody who's like retired and just needs a place to park money, and they don't want to look for an asset like every 3 to 5 years. They're good.
100%. It's definitely where you are at in life too on your investing strategy. I was talking to my daughter the other day about, if we can double your money every 5 years, what would your $1,000 turn into in 50 years? She's like, 50 years is so long. I'm like, you're going to be 63. That's it. That's super old. But anyways, regardless, we went through the math, and I'm like, look, you can be a millionaire by that time, just with that first, I think it was $1,200 or whatever it was.
Has
you
she
got to
tried
keep
to
on
get you
moving.
to pay the doubling the pennies every 2 days? My daughter just tried that on me.
I'm not doubling your pennies.
I'm not doubling your pennies at all.
I'll do it for 3 days.
Right? My husband's like, why not? I'm like, do the math behind that.
Yeah, do the math quick on that one. It adds up pretty quick. Doubling money is amazing. Well, all of a sudden it goes really slow. And that's the thing that the investors have to understand. And I tell people this too, because I get a lot of people that want to, quit their job and figure it out. I'm like, look, the first 5 years is going to be nothing. It's a really, you're not going to feel like it's even made a dent. But then that asset sells, and then all of a sudden you've got double the money potentially, right? If things go well. And that 50 turns into 100. And then all of a sudden that 100 turns into 2. And now when the 2 turns into 4, that's a pretty big jump. And the 4 turns into, wow. And now we start to talk. So it's not the first time. It's not even the second time. But by the time we get to that third, fourth, fifth time, wow, now we're talking some big returns. That's the power. And so it's patient money is really key for investors. It's not thinking that hey, we're going to invest in this real estate deal and we're going to become a millionaire overnight with 50 grand. It's just not going to happen. But you can become a millionaire slowly if you do it right.
Mm-hmm. It's not timing the market, it's time in the market, right? Like,
yeah, absolutely. Speaking of that, what are you guys doing today with the market shift? Like, what's your thought? You just said it's not time in the market or not timing the market, it's time in the market. But now we got this market dynamic that we got high interest rates. We got banks that are going under. We got an economy. I mean, everybody keeps saying we're going to be in this big recession. Some people think it's worse than others, and so on. And so there's a lot of uncertainty. There's talk about commercial real estate crashing, or whatever. There's a lot of talk out there. So what's your thought in today's market? What does a prudent investor need to be doing?
Yeah, I had the pleasure of watching Johnny Chang. He's the one in the lead economist at Marcus and Millichap talk at a conference back in March. And, he brought up a really good, several good points of, that, and mind you, we had heard rumblings about Signature in SVB. Like that happened during this conference, but this talk happened the morning that all this was going down.
Oh, wow.
And so by later that afternoon, we're like, where's Johnny? Does he still think the same thing?
Yeah. Can we ask him again? Come up on stage.
Yeah. But I mean, the fundamentals, just think about it. We have a lot of onshoring and reshoring of jobs. Especially if we're talking about industrial, office space, and residential. These jobs are coming back. We're already underbilled by 4.3 million, homes currently. And, we just can't provide housing to all these jobs that are being reshored back into the area. And we can't reshore them fast enough. I think we need to ideally, we should be reshoring 500,000 jobs a year. And if we can get 250 back right now, 250K back right now, that's like probably the biggest push we can make.
Yeah.
Still not like completely throw everything out of whack. Then we've got like the collision in the millennials and the boomers happening right now. The millennials are they're making their first homes, right? And when I say making their homes, they're getting married, they're having kids.
Yep.
They're no longer going to be living in the urban cores. They're going to push out to the suburban cores, and those businesses that have been serving them are probably going to be following them. And so I think we're going to see huge expansion. Now, it's not going to be in every market. You can't just look at whatever market you're in and this is going to happen in your backyard.
Yeah.
Like certain, it might work really well for Denver, Colorado, and like towns in the Southeast, but we're seeing, some towns in California, a big exodus, right? So we're seeing, the shifting of where these people are living. Yep. We've got boomers competing for the same houses. They're downsizing, and they're more likely to rent too, because if they can't purchase as well,
or they don't want to make that big purchase a lot of times, right? They sold their house that they've been in for how long, and they're like, we're not gonna purchase right now. Like, let's just rent for who knows how long, maybe the rest of their lives, but they're gonna rent for a while.
Yeah. I just a good friend of mine, like her husband's dad had been living with them, and they were trying to find a rental here in Boulder, Colorado. And he's in his 60s, and they were like, they just finally scratched their head, and they were like, wait a second, he can go into an assisted living. Not that he needed that, but he was just like, wait a second, for the same rent that he would be paying for a single person flat, he could move into an assisted living retirement community. And now maybe just $100 more a month, but he had all of his meals cooked. He gets a housekeeper like once a week. It was just like living the life. And I'm like, why not? Yeah. But the other thing that's happening is we're going to see this massive wealth transfer. Now, we've been talking about this wealth transfer from boomers to millennials for a number of years, but originally, just 2 years ago, this wealth transfer was projected to be $6.3 trillion. Now, it's estimated to be 84 trillion. Okay, so we have this massive transfer, but all that capital needs a place to invest. So, and even if just half of it went into like the stock market, we've got another half of it, that's going to, continue to push transactions. in other asset classes, real estate included. So those are some things there that I don't go into this with rose-colored glasses, but those are things I kind of have my eye on to be like, yeah, I mean, we're having some tough times right now, but don't let the tail wag the dog. There's still a lot of fundamentals in our favor for real estate. Now, I don't think it's so much like commercial real estate globally come crashing down. I think we've had bad money going into some of these assets. And I think those assets are going to be challenged. I mean, I don't hear this talked about a whole lot right now. And so I think investors got savvy that if they invested in an asset that had floating rate debt, they should look for that floating rate debt to have an interest rate cap. Okay. Well, that cap, say it's a I'm just going to throw out random numbers here, but say it was an $80 million building. That cap a year and a half ago probably cost $100,000. That same cap today is going to cost $3.4 million. So if you're in a value add strategy where that person either has to sell to somebody else or refinance out of a short-term bridge loan, what are they doing with the interest rate cap? Because the bank is going to still require the cap, but the cap's no longer $100,000. Right. It's $3.4 million. Right. And so I think that is good where we're going to feel the pinch in commercial real estate. Now, what am I doing personally? I'm still, I'm looking at assets. I'm looking at assets that adhere to the 7 pillars of wealth. They preserve capital. They cash flow now, today, in today's market, right now, with everything going on. Have good, solid plans for equity growth. They have amazing tax benefits associated with it. They have smart use of leverage, because leverage can cut both directions, and we're going to see that soon. And they're inflation hedging, and then they're with great operators. Now, if you're the operator, you got to know your stuff. If you're investing with other operators, it has to be somebody that has knowledge, expertise, a track record, the ability to perform all aspects of that transaction, the due diligence, the underwriting, the operations, and they have to be able to get a good leverage on the deal. I mean, because somebody can get a good deal, but they don't have the balance sheet to acquire good debt on the property. It doesn't matter how great the deal is. I mean, the debt right now will make it. And then be able to operate that deal, have a team in place to operate that deal. So those are the 7 pillars that I look for, and
love it.
Every asset has to have all 7 for me right now.
Yeah. Yeah. It has to check the boxes. I think you're right on. I mean, there's a lot of talk about the debt that's out there and what's going to happen with it. That's going to be very interesting to see. What's interesting to me is a couple things. First of all, it's that there's certainly a lot of debt out there right now that is at risk, but how much of that debt will the risk actually get to the point where it's no longer serviceable, right? The lender has to foreclose or, come into receivership or people. So there's that. So there's the foreclosure. Of course, that's the real distress, right? That's going to cause a lot of havoc on the market. But how much money is in the waiting, right? Just saying, hey, we're going to rescue you. We're going to take this over. Nobody will even know about this, or very few people, right? It's not going to come public. They're just going to take it over, and you might be kicked out of the GP, and some of the LPs might lose some money, but it just kind of goes there. It's going to be interesting to see what happens there. The other thing that happens is when things get a little bit rocky, even though there's a lot of capital, the capital gets really scared sometimes. And so even though we say there's all this rescue capital out there, is it willing to rescue if things get dicey? So it's all going to be interesting to see how it plays out. I can't predict the future. I wish I could. You and I would be a lot more wealthy if we could predict the future, but I just know that it'll be interesting to watch, I think, the next probably 24 months to see what happens in real estate in general. But I agree. I mean, your points made earlier are very sound. Look, there's a big wealth transfer. There's especially for housing, there's huge need for housing. None of this stuff is going away. So if you can hit your 7 pillars that you mentioned.
Started today.
Yeah. You can hit your 7 pillars that you mentioned. You're doing great. So Whitney, we got to wrap up. I got a couple more questions before we wrap. What's a favorite book that you can recommend to our listeners?
I still like subscribe by The One Thing from Jay Papasan and
Love that
Gary
book.
Keller. It's a book I read every year. It just it's just one that I think everybody should not just read once or twice, honestly, but revisit and make sure that you're creating that vision for yourself, that you are putting the time blocks in place to do your most important work first. And we talk about wealth creation, focusing on those experiences that you want to create in your life and with your family. To me, that's true wealth.
Yeah. Yeah, definitely. How do you like to give back?
So I give back a lot, with my child. She's at home. She does her education at home, and I figure if I can like pour as much of myself into her as I possibly can, I mean, it's going to be exponential of what she does in the world. But also I give back to my listeners with the Passive Investing Made Simple show, and also with my work at Ash Wealth.
Love it. Love it. What's a mistake that you've made and how have you learned from it?
Well, in the investing world, how many mistakes can we go through? No, just kidding.
Just one.
Just one, right? So, I think when I started getting into passive investing, I thought because we had all this cash built up, with our flipping and everything, I was like, I got to get it all invested now. Well, again, that ready, fire, aim mentality. I was like, I got to get it all deployed this year. And I went into a couple of deals where I trusted the people that were already in the deal, but I didn't know the operator thoroughly. And I lacked the skills at that point in time to underwrite the operator appropriately. And I got enamored with the numbers, like what a lot of passive investors do. They look at the numbers and they're like, oh, I kind of like the market. And then, they're like, okay, let me invest. And I'm like, wait, they haven't asked one question about who we are at passiveinvesting.com. And I asked him, I was like, well, what do you like about the market? And then either I figure out they've done their homework or not, right? And then I'm like, well, let me tell you about how we operate here, just so they can really, kind of get to understand who we are and know, love, and trust us. But that was a skill that I had to learn the hard way.
Yeah, it's getting enamored by the numbers. I hear it from investors quite a bit. Like, oh yeah, I'm looking at another deal. They got really attractive numbers. Okay, sounds good. And I could make my numbers look really attractive too if you'd like me to.
Just requires a computer or a typewriter. That's it.
That's it. Yeah. All right. So last question. What are your 3 pillars of wealth creation?
So, just having run through the 7 pillars already on like kind of how I evaluate my deals on broad strokes. I think for me, I sit down and ask myself 3 questions minimally once a year, if not, biannually now. They're like, what do you want? Why do you want it? And who do you have to become to get it? Like for me to get to the next evolution of my portfolio growth or personal growth, I need to fully understand, what do I want? Why do I want? Why am I going after this? And then who do I have to become? Like, what are the mindset, skills, and networks I need to have in place in order to achieve that? Because that's constantly changing.
Yeah, I love that. Yeah. I mean, you should be looking at that, like you said, like minimum once a year, but maybe even more. What do you want? Why? Why do you really want that? And you might end up finding out that that's not really what you want once you go through that process. But then who do you need to become? Like you're always got to be continuing to improve yourself. So who do you need to become to get to there? That's so valuable. So I really appreciate that. Whitney, how can our listeners get in touch with you or learn more about what you got going on?
Yeah, definitely. They can reach out to me at passiveinvestingwithwhitney.com. And then there I've got a free ebook for everybody about how to get into passive investing, real estate. And then also they can get access access to my calendar there as well.
Love it. Whitney, really appreciate it. We'll put that all in the show notes. Appreciate you and the time you've been able to spend. Have a fantastic rest of the day.
Awesome. You too. Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.